Hey everyone, welcome back to Corporate Decoder, where we decode the confusing language of business and finance so you don't have to. And today we're diving deep into Meritage Homes Corporation's latest quarterly report. Think of this as your financial cheat sheet so you don't have to wade through pages and pages of corporate jargon. Alright, let's get right into the meat of it. The financial numbers. Looking at their balance sheet for the 30th of September 2025, we see a couple of key things. Cash and cash equivalents are sitting pretty at over $728 million, which is up from about $651 million at the end of last year. That means they have a good chunk of money readily available. Real estate holdings are substantial, clocking in at over $6.1 billion. That makes sense for a home builder, that's their main product. On the liability side, senior and convertible senior notes are a big number, close to $1.8 billion. This is the debt they owe. Now let's look at the income statement for the third quarter, ending the 30th of September 2025. Total closing revenue was about $1.4 billion, down from nearly $1.6 billion in the same period last year. That is a drop of over 11%. The cost to build these homes also went down, but not as much, leading to a lower gross profit for home closings. Financial services, which is like their side hustle offering title, and mortgage services brought in a profit of over $4 million, which is up from about $3 million last year. Overall, net earnings for the quarter were around $99 million, significantly lower than the $195 million reported in the same quarter of 2024. That is a big drop, almost half. For the 9 months ending the 30th of September 2025, home closing revenue was about $4.3 billion. This is down from over $4.7 billion in the same period last year. That is an 8% decrease. Home closings fell by 2.6%, and the average selling price of those homes also dropped by nearly 6%. This combination really ate into their revenue. The home closing gross margin, which is the profit they make on each home after accounting for building costs, took a hit this year. For the 9 months of 2025, it was 20.7%, down from 25.5% in 2024. That is a nearly 5 percentage point drop, which is huge. This means for every dollar they made selling a home, they kept almost 5 cents less. They also talk about an adjusted home closing gross profit, which excludes certain charges like impairments and write-offs. Even with these adjustments, the margin for the 9 months of 2025 was 21.2%, still down from 25.6% in 2024. So even when you strip out those one-off costs, the core business profit margin is lower. Looking at their regional performance, the West region saw a significant drop in home closing revenue. It fell by almost 30% year over year for the third quarter. That is a big decline, and it was driven by fewer homes closing and a slight dip in the average selling price. The Central region also saw a revenue decrease of almost 9% in the third quarter, with both closing volume and average selling price declining. The East region, however, showed some growth. Home closing revenue increased by about 5.7%. They closed more homes, though the average selling price also dropped there. Now for what is coming down the pipeline, home orders. In the third quarter of 2025, they got 3,636 new orders, a slight increase of 3.5% from last year. That is positive, but the dollar value of these orders was flat because the average selling price for new orders also went down by over 4%. Their order backlog, which is the value of homes ordered but not yet closed, decreased significantly. At the end of September 2025, it was valued at about $670 million, down about 28% from the same time last year. This means they have fewer homes pre-sold for future closings. The company explains this lower backlog by saying they are selling homes later in the construction cycle, a strategy focused on having move-in ready homes available quickly. On a positive note, they ended the third quarter of 2025 with 334 active communities, up from 278 in the previous year. This means they are opening new subdivisions and expanding their reach, which is a sign of future growth potential. Their cancellation rate, which is the percentage of ordered homes that buyers back out of, was 11% on average for the third quarter. This is a slight increase from last year, but still below their historical average. The company attributes this to their strategy of having move-in ready homes, which reduces the time between ordering and closing, making deals more solid. Let's look at expenses. Commissions and other sales costs went up to over $99 million, representing 7.1% of home closing revenue, up from 6.2% last year. This hike is due to higher commission rates paid to realtors, reflecting a tougher sales market, and also costs associated with holding more spec homes, which are homes built without a buyer already lined up. General and administrative expenses, the overhead costs, actually decreased slightly in dollar amount, but as a percentage of revenue, they held steady or slightly increased due to lower overall revenue. Their income tax rate increased slightly to 22.6% for the third quarter, up from 21.6% last year. The company says this is because fewer homes now qualify for energy tax credits under a new law. We have to remember that these are quarterly numbers. Looking at the 9 months of 2025, net earnings were about $369 million. That is a substantial drop from $613 million in the same period of 2024. That is nearly a 40% decrease in profit. Now let's talk about their debt. Their debt to capital ratio was 25.7% at the end of September 2025, up from 20.6% at the end of 2024. This means a larger portion of their company is financed by debt. Their net debt to capital ratio also increased to 17.2% from 11.7%. This indicates they took on more debt, especially after issuing $500 million in senior notes earlier this year. They mentioned they are in compliance with their credit facility covenants. This is good news, showing they are meeting their loan obligations. They also have a minimum tangible net worth requirement that they meet, and their leverage ratio is well below the limit imposed by their lenders. Like many home builders, Meritage experiences seasonal fluctuations. They typically see more orders in the first half of the year, which requires more cash up front for building and land. This year, however, they expect their strategy of having ready-to-close homes to potentially shift some of these cash needs earlier in the year. Meritage is navigating a challenging housing market. The report shows they are facing increased costs and lower profit margins due to factors like higher interest rates and rising land costs. Their strategy of offering move in ready, affordable homes and expanding their community count is a clear attempt to counter these headwinds. The drop in profit and backlog is concerning, suggesting that sales may be slowing down or profits per sale are shrinking. However, the increase in active communities and a decent amount of cash on hand provide some optimism for the future. The rising debt levels are something to watch closely, especially in an environment where interest rates are volatile. Alright, that is our breakdown of Meritage Homes' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.